Good morning, traders and investors. Roger Scott here, senior strategist for Wealth Press. It's Monday. It's April 10th. Don't ask me how we got here. I have no idea. I can't believe the first quarter's over, and I can't believe the first quarter's already almost 2 weeks in. It's about 7:18. I'm here nice and early because I have an appointment at 8 o'clock, and I wanted to get you this data ahead of time. This is going to be a very important week. Now, I usually say that, but I really mean it, and let me explain to you why. There's something interesting setting up here, and I'll go through this again, but I wanted to just give you a highlight. On Friday, when the market was closed, we had the employment report, and everybody thought that the employment report was going to be loosey-goosey, that it was going to be showing a lot of unemployment. And unfortunately, or fortunately, depending on how you look at it, the employment report was really tight, and it shows that the labor market is humming along perfectly and is not slowing down. Now, once the report came out, this is what the bond market did, just to show you an example. It went down. It went down. The reason the bond market went down is because if the employment is solid, then there's a higher chance that the Fed will increase rates. When Feds increase rates, bonds go down because there's an inverse relationship between bonds and interest rates. The stock market didn't do anything on Friday, but this morning it is a little looser. Now, this is very random action. And if you look at the 10-year, you could obviously see that it's up a little bit, 2 ticks. But it's definitely down as of Friday. It closed on Friday, on Thursday, right around 116 and 18, and now it's at 115.26. So it's definitely lower than it was on Friday, and that changes the dynamic of things because then the Fed doesn't have we're going to slow down because employment rates are going down. They can't play that game because employment numbers were very, very steady. They came right in line with estimates and somewhat even beat expectations. So that kind of changes the dynamics of what the market's expecting, and it changes the dynamics of what's priced into the bond market. Now, on that note, let's review this week's data, and then I'll get into the nitty-gritty. So today we don't have a lot on our plate today. Tomorrow we have Austin Goolsbee speaks, not a big deal, but then things get really interesting. On Wednesday we have the CPI report. Now this is a huge, huge, huge report because it tells us where the inflationary pressure is and how bad it is. And we have FOMC minutes, which get us into the mind of the Fed from a week ago to see what those schemers were thinking when they were raising rates or not raising rates, or basically at 0.25. And then we have PPI, which is the producer's price index, also very important, not as important as the CPI, but also very, very important. And then we have jobless claims, and on Friday we have a whole slew of information: retail sales, industrial production, consumer sentiment, a lot of reports. So this week is going to be jam-packed. Now, in terms of expectations from the CPI, and then there's more that I want to talk to. I'm just getting started here. But the CPI, what I care about is the core, X food and energy right here. And the numbers are getting kind of tight, and we're on the upper end of the range. Now, last time we were at 5.5. Now we're looking to be at 5.6. It'll be very interesting where it comes in. And I'll be talking about whether it's coming off or not, but it looks like it may be getting a little worse than better. So it'll be very interesting how this number comes up, and I will talk about this as we get into Wednesday. But right now we're on the upper end of the range at 5.6. The expectation is 5 to 5.6. Here we're expecting to go a little lower. It'll be very interesting to see if the number is in fact lower or not. And then we have the PPI. The other big reports are, and I'll start giving you guys my PDF as we get later towards the week, we're officially starting earnings season on Friday with the big bank stocks. I'm not sure which ones are reporting, but usually it's Chase, Wells Fargo, Bank of America, and a couple of others. But those are the big ones, and they're starting to report late this week. Don't quote me on which ones. I'll give you a full update on that later. Now, so there's several things. Friday's report was better than expected, means bad for the stock market, takes a chip out of the Feds. We're gonna pivot. No, I don't think they're gonna pivot at all, and neither does the bond market. Then we've got the CPI, then we've got the minutes, then we've got the PPI, then we've got earnings on several bank stocks, and obviously bank stocks are a little more important now than they were a year ago because of all this mishigas and craziness with the banking sector. And then you got more reports on Friday. It's going to be a very, very important week for the bond market. And as you know, the bond market gains a lot of its value from the stock market. Now, let me explain all this to you. And a lot of what I just said is in the summary, but I think it helps to go through this, to cement this into your brain. And then we'll talk about the most vulnerable sectors for the week and what we're expecting for the S&P 500. So we're down about 0.34 this morning as markets participants assess labor market data from Friday while waiting the release of U.S. inflation and minute data. That's what I was referring to right here, just to give you some idea, to give you some color on what we're talking about. U.S. Labor Department, this is the Friday report I was talking about, showed that non-farm payroll rose 236,000, very close to the estimates of 239,000. And it wasn't weak, it was strong, pointing to persistent tightness in the labor market. Unemployment rate fell to 3.5% from 3.6% to add insult to injury, stronger than expectation. So things are really not looking that bad. And as a result of that, as I said, the bond market went down. And now, again, we have a 64% chance of a 0.25 rate hike and only a 36% chance of no rate hike, which completely switches the odds again. I think this is the third time since the Fed reported interest rates last time, since the FOMC, that we've had this happen. I mean, I've never seen it this tight. It was 64, we're going to raise rates, 60, we're not going to raise rates. Now it's again 64, we're going to raise rates. They keep coming at us, but it's very interesting because this is a very, very interesting report, and I'm sure this week's CPI will cement some of those numbers. But as of right now, it looks to me, and the bond market agrees, the Fed is going to keep doing it. And by the way, last week, both Feds, I forgot which ones it was. It wasn't squirrely Mr. A.K. Powell. It was two other ones. The two that were a little more honest. I think Brainerd was there. I'm not sure. Anyway, this coming week, we've got CPI data for March. That'll be the main highlight as investors look for more clues on near-term path of interest rates. I didn't read this before giving it to you, but as you could see, everything we discussed is here. But this is good for you guys to see it in writing to get a reinforcement of all of this. All eyes will be on the U.S. core CPI. That's exactly what I was pointing to. Crude oil inventories, core PPI, jobless claims, and retail sales, core retail sales. I think all retail sales. It'll be interesting to go through these reports. In addition, we'll be watching clues from the Fed's minutes to see if there's further clues. Honestly, we don't need those clues because we have Friday's report, and by that time we'll have the CPI. We're going to have a really good idea of what's going to happen. Meanwhile, big banks, including JP Morgan, Wells Fargo, and Citigroup, that's the one I forgot. I thought it was B of A, kick off their first quarter earnings season later this week. It's actually all starting on Friday. That's why I'm a little slow to give you the nitty-gritty data because we've got a lot of time left. Shanghai Composite closed lower as flare-up and geopolitical tension around Taiwan weighed on risk appetite. China announced 3 days of drills on Saturday after Taiwan president returned to Taipei following a meeting in Los Angeles with U.S. House Representative Kevin McCarthy. China, what are we going to do with you? Japan closed higher as no COVID at least that's what we're hearing now. Higher as yen weakened following U.S. labor data that shows hiring slowed more than expected, but remained steady in March. I don't know how well they're going to do, Japan's going to do with their low interest rate environment. In terms of vulnerability, and folks, this is going to be a big week for the bond market. And I think what we're going to be seeing from the bond market, which is closed, it's going to open up almost a basis point down right here, as you could see right there. And because of Friday's report, I'm expecting things to cool off, to drastically cool off, and bonds to go down. Look at this little ascent right here they had because they got all happy because they thought the Fed wasn't going to raise rates. They thought the employment data, ADP, was weak. So bonds started moving higher, which means interest rates lower, which is good for tech. And I told you guys, no soup. Looks like we had a turnaround, and it looks like we're already lower and going to go into the money, which means I'm expecting bonds to go lower, which means higher rates as the week goes by. Now, what sectors are most vulnerable to this right now? Sectors that are the most overbought. Utilities. Utilities are really overbought right now, and they have a big impact from the bond market. If you don't believe me that they're overbought, look at where we're at right now. I mean, this is like at a high, period high right here. Hey, look at that. Every time we go up to this level, what happens? We cool off. It doesn't look pretty. The communication sector, and the communication sector has a lot of technology in it, doesn't look all that great. It doesn't look all that great. Look at where it is right now. Would you want to be a buyer of telecommunications? Hell no. And that's Google, that's Facebook, that's a lot of Twitter, that's a lot of market cap there. And how about healthcare? Healthcare doesn't look all that great either. But again, it doesn't mean it all has to happen at the same time. I would just be very, very cautious right now with healthcare. In terms of other sectors that are a little, we've got, let me show you where consumer discretionary is not up that much. Consumer staples is up, but so is the 50-day. So consumer staples could stay around this area. Industrials are still have a lot more exposure. It's the healthcare. I guess it's the ones that I just showed you. Energy also. Look at energy. Whew. Look at this. Energy, utilities. It looks like they can cool off a little bit. Things are just overbought right now. So I'm expecting the stock market, in terms of the SPY, to potentially cool off, like it's cool off and continue basing. I'm not necessarily expecting it to go down all the way, but if we did see a little cool off in the SPY, it wouldn't be such a big surprise. Not at all, actually. So don't be shocked if you see the sell-off on the SPY. Also, notice the SPY couldn't reach the previous high, which isn't all that great, but it did look like it peaked out right here from a period all the way back there. But it looks to me like it's at that level where it's going to have trouble going higher, especially if the Fed data shows that things are pretty much, CPI hasn't changed. If inflation's still there, if CPI is bad, the Fed is going to do 0.25. It may even go up to 0.50, but I don't think that's going to happen. I think 0.25 is baked in. Overall, let me go through the individual sectors to show you where I'm seeing the technical action, and then we'll conclude. But bottom line, we've got a lot of stuff this week, a lot of goodies, and you got to be really, really careful because technology communications are still leading. See, I personally think consumer staples is going to lead, and consumer discretionary communication and technology is on its way down, because if bonds go down, interest rates go up. And guess what? Two sectors, communication services, which is grossly overbought, is part of that gross. Look at that. This is communication services. It's up here. Look at it right here. Doesn't look all that great. So to me, it looks like there may be some real downside coming our way over the near term in terms of these sectors. Now, again, I'm not trying to panic you. I'm not trying to worry you. I'm not trying to tell you that the stock markets fall apart. I'm not seeing that at all. But what I am seeing is less enthusiasm that the Fed market is slowing and that the labor market is slowing, which means the Fed will be weaker. I'm not seeing that at all, and either did the job report. So ADP was just totally off, and it looks like we may be seeing 25 points. If 25 points is there, then the market, the happiness we've seen in the bond market, is going to deflate. And if that happens, it'll put more pressure on tech and interest rate sensitive stocks. So we got to be really, really careful this week. Now, folks, most of you know me as a permabull. I've dedicated my life to finding market's strongest stocks, right? I'm always looking for strong stocks. But right now, the opportunity in the weakest stocks, yes, the weakest stocks, especially in light of this interest rate mishigas, is too big to ignore. I don't have to tell you that stocks are crashing lower. They are. A lot of stocks are moving lower right now. There's a lot of stocks making 52-week lows. And it's just too big to ignore. And it's a low-hanging fruit, which we want to take advantage of right now. Now, I don't have to tell you this because you know this, because you see me talking about short trades. And I've been increasing shorting trades in various programs. Now, thanks to a single pattern that preceded some of the market's biggest drops, we can use the worst stocks to find some of the best potential trading opportunities. Oh, I love that. The worst stock, best trading opportunities. Remember Dish? What else do I have to say? Dish, that's all I've got to say. And I'm holding a special training session that's going to be really cool. You've never seen this before. This is the first time brand new world reveal, brand new program. Very, very cool. You guys got to see this. Very, very cool system. I'm exposing it all at 1 p.m. on Tuesday, tomorrow, April 11th, and I cannot wait to share it with you. Follow the link below this video to register right now. Also, keep in mind, if you don't know where the link is, go to the YouTube Wealth Press channel. The link is there. It's right below the video description. And there's a Telegram channel where you can get some free trades sometimes. Like this channel, subscribe, post comments, feedback, all the good stuff, all the bad stuff. I'll take it all. I have a thick skin, depending on what time of day it is. No, I'm just kidding. And I'll talk to you later. Remember, tomorrow, a world reveal. This is an opportunity to make money in stocks that are going down. And yes, with interest rates going higher, and I think they are going to go higher, there's a good chance that stocks are going to go a little lower, and that gives us opportunity. Remember, 1 p.m. Eastern time, tomorrow, Tuesday, 11th. That's Tuesday, 11th of April. I can't believe I'm saying that. 1 p.m. Eastern time, don't miss out. Follow the link below, like this channel, subscribe, and post me comments. Bye, guys. Have a great week ahead. It's going to be a busy one. Stay tuned.